Most people are told that building a strong stock market portfolio is complicated. You need to pick winning stocks. You need to time the market. You need to adjust your positions constantly. But what if that is not true? What if you could build a strong portfolio with just 4 investments? And what if that portfolio was designed to do 2 things at the same time? Grow your money and help protect it. That is exactly what I want to show you in this video. Because if you ask the mainstream financial world how to build a portfolio, the standard answer is usually very simple: 60% stocks and 40% bonds. And personally, I disagree with that model. Not because it is popular, not because it is traditional, but because I do not think it is truly built for the world we live in today. Here is why. When experts tell you to own bonds, that can include things like corporate bonds, mortgage-backed securities, and other fixed income investments. But usually, the core recommendation is U.S. Treasury bonds. The reason they recommend that is simple. Treasuries are supposed to give you interest income and are often viewed as safe. Welcome to Bridgeport Finance Channel. So the idea is that 40% of your money sits in something safe, while the stock portion gives you growth. Sounds reasonable, right? But here is the problem. Fixed income can lose purchasing power during inflation. And that means the so-called safe part of your portfolio is not always truly safe. If the real rate of inflation is higher than the interest you are earning, then your money may be growing on paper while losing value in the real world. That matters because if treasury bills or bonds are paying around 3% to 4%, and that is before taxes in a taxable account, then your real return may be much lower than it looks. So let me show you what I personally prefer instead. And to be clear, I am talking about your paper investment portfolio as a whole. That means I am looking at everything together: your 401k, 403b, IRA, taxable brokerage account, and other market-based investments. I am not including your primary home, rental real estate, physical precious metals, 529 plans, or HSAs. Those serve different purposes. So when I look at a total paper portfolio, this is how I would structure it: 50% in S&P 500 index funds or ETFs, 10% in international stocks through an index fund or ETF, 20% in gold, and 20% in what I call an opportunity bucket. That is it. 4 investments, simple structure, clear purpose. Now let's break down why this works and why I believe many people overcomplicate investing. First, the foundation, the S&P 500. I would put 50% of the portfolio there. That means half of your portfolio is invested in an S&P 500 index fund or ETF. Why start there? Because this gives you a strong core without forcing you to pick individual stocks. You do not need to guess which company will win. You do not need to constantly rotate in and out of positions, and you do not need to act like a full-time analyst. The index does the heavy lifting for you. If a company becomes weaker over time, it can eventually be removed from the index. If another company grows stronger and becomes more important in the market, it can be added. So in a practical sense, you are continuously holding many of the strongest large companies in the market across different sectors. That is a powerful base for long-term growth. Now let's add the second piece, international stocks. I would allocate 10% there. A lot of investors ignore international exposure, but putting 100% of your money in one country, even the United States, still creates concentration risk. Different countries go through different economic cycles. Some regions may be growing while others slow down. Some currencies may strengthen while others weaken, and some markets may offer opportunities that your home market does not. So this part of the portfolio is not about chasing the highest return. It is about spreading risk over time. Personally, I would use a fund or ETF that includes both developed markets and emerging markets. Developed markets are generally more established economies, such as Japan, Germany, the United Kingdom, and Canada. Emerging markets are countries that may grow faster, but usually with more volatility. Examples include China, India, Brazil, and South Africa. By combining both, you get broader diversification across regions, sectors, and currencies, and that matters more than many people realize. Now, here is where this portfolio starts to look very different from the standard model. I would allocate 20% to gold. Most traditional portfolios either ignore gold completely or give it a very small role. I see it differently. To me, gold is not there for aggressive growth. Gold is there as protection. Think of it as insurance inside your portfolio. When currencies weaken, gold often benefits. When confidence in paper money drops, gold tends to get more attention. When inflation erodes purchasing power, gold may help offset some of that damage. And I want to make this idea simple. Imagine you buy one physical gold coin and hold it for 5 years. At the end of 5 years, you still have one gold coin. It did not multiply, it did not go to work and create more coins. So gold is not productive in the same way a business or stock can be productive. But the reason many people still value gold is because over time, it may take more devalued dollars to buy that same coin. Why? Because governments and central banks can expand the money supply. They can create more currency, but they cannot print gold. That is the core idea. Now let's talk about the final 20%, which I call the opportunity bucket. This is where you can take calculated risks and express your own conviction. And that could include things like silver, copper, uranium, oil and energy, tech stocks, REITs, Bitcoin, crypto, cash, or even some fixed income exposure if you choose. Personally, I would be cautious with treasuries, but that is my view. The point is not to gamble wildly. The point is to give yourself room to personalize your portfolio without putting your entire financial future at risk. That distinction is important. There is a big difference between smart investing and reckless speculation. And this structure helps create that boundary. Your core stays strong, your protection stays in place, and your higher conviction ideas stay contained. That way, even if one of your opportunity positions goes wrong, it does not destroy the entire portfolio. So what does this allocation actually achieve? In my view, it gives you 4 things: growth through stocks, protection through gold, diversification through international exposure and asset variety, and flexibility through the opportunity bucket. But there is one more benefit that I think matters the most. This kind of structure can help you stay invested. And that is critical, because in my opinion, the biggest mistake most people make is not choosing the wrong ETF. It is their behavior. They panic during downturns. They try to time the market. They jump in and out too often. They pull money out too early, or they never even begin because investing feels too complicated. That is usually the real problem. Not knowledge, not access, not opportunity, behavior. Personally, I do not believe in trying to perfectly time the market. I believe in building a structure that you can stick with over the long term. Will there be volatility? Absolutely. Will there be scary headlines? Of course. Will there be corrections and crashes? Yes. But historically, markets and asset prices have tended to move higher over long periods, especially in a system where currencies can be continually expanded and inflation pushes nominal prices upward. That does not mean every asset rises all the time. It does mean that long-term discipline matters more than short-term noise. Just think about it. Do most people seriously expect the median home price to go back to 1980s levels? Probably not. Do most people expect the price of a new car to return to 1990s levels? Again, probably not. So when you zoom out, it becomes easier to understand why many investors believe long-term ownership of productive assets matters. There will always be ups and downs, but staying invested is often the hardest and most important part. So why do so many people fail to build a good portfolio if the strategy itself can be simple? Because simple does not mean easy. Consistency is hard. Discipline is hard. Patience is hard. And for people who watch their portfolio every day on their phone, the temptation to constantly trade can become very dangerous, especially if they do not fully understand what they are doing. Sometimes less really is more. Now compare this approach to a standard industry portfolio. The traditional model says, go heavy on stocks, hold bonds for safety, and usually keep very little or no gold. Why is it built that way? In my opinion, because the system is centered around financial assets, not necessarily around true purchasing power protection. Bonds are labeled as safe, but in inflationary periods, they can quietly lose real value. Gold is often minimized because it does not fit neatly into the Wall Street model of income-producing financial products. So the way I see it, many standard portfolios are designed to fit the system first, not necessarily to maximize smart growth while also protecting purchasing power. This portfolio tries to take a different approach. It does not rely on just one outcome. It prepares for multiple possibilities. If the economy grows and stocks perform well, your core equity allocation benefits. If currency debasement becomes a bigger issue, gold may help protect part of the portfolio. If there are major upside opportunities in areas you believe in, your opportunity bucket gives you room to participate. That is why I believe it is more balanced. And in my view, better balanced usually means easier to hold through uncertainty. So let me leave you with this. You do not need a complicated portfolio to build wealth. You do not need to constantly trade. You do not need dozens of positions, and you do not need to act like a hedge fund manager. What you need is a simple structure, clear purpose, discipline, and time. That is what matters. And if you found this video helpful, subscribe to Bridgeport Finance channel, like and share to someone that may need to hear this. Thank you so much for subscribing and watching. I appreciate your time. Take care, and I will see you in the next one.